We're charting the course for an enlightening expedition into the realm of dividend investing. Our destination: building a diversified dividend portfolio strategy. It's a topic that can seem daunting, but worry not. By the end of this video, we'll turn it into a delightful stroll in the park. Let's start with the fundamental question. What are dividends? Dividends are a portion of a company's earnings paid out to its shareholders. When you buy a share of a company that distributes dividends, you get a monthly, quarterly, or annual payout. It's a reward you get for being a part owner of the business. Now, isn't that nice? And why are dividends important? A well-structured dividend portfolio can serve as an extra income stream and provide a buffer during the turbulent tides of market volatility. Do you want free shares that could be worth thousands of dollars? Check out the links in the description. And if you like the video so far, suplex the like button and subscribe for investment and entrepreneurial insights. So, how do we build a diversified dividend portfolio? Step 1. Understand your investment goals. We all have unique financial objectives. Whether you're saving up for a beachside retirement, your dream house, or that sweet sailboat, your individual goals will determine the construction of your portfolio. Understanding your risk tolerance and investment horizon is also essential in this stage. This crucial step sets the foundation for all your investment decisions. Take some time to reflect on what you hope to achieve with your investments. Are you saving for retirement, planning for a major purchase, or simply aiming to grow your wealth over time? Identifying your goals will help you determine the right approach to building your portfolio. It's also essential to consider your risk tolerance and investment horizon. Are you comfortable with taking on higher risk investments in pursuit of potentially higher returns, or do you prefer a more conservative approach? Additionally, how long do you plan to invest your money before needing to access it? These factors will shape the composition of your portfolio and the types of dividend stocks that align with your objectives. Next stop on this journey is identifying the right sectors. The golden rule of not putting all your eggs in one basket is incredibly pertinent in investing. By diversifying across different sectors, you spread your risk and position yourself to benefit from various economic cycles. Spreading your investments across various sectors like healthcare, tech, energy, consumer goods provides exposure to diverse economic cycles and can offer some protection from sector-specific downturns. Each sector has its unique dynamics and performance drivers. For example, healthcare tends to be more resilient during economic downturns, while technology offers growth potential. By allocating your investments across multiple sectors, you reduce the impact of sector-specific risks and increase the likelihood of overall portfolio stability. The third milestone is choosing solid dividend stocks. It's not just about chasing high yields. It's crucial to look at a company's dividend history and payout ratio. Look for companies with a track record of consistent and growing dividends. This indicates a commitment to rewarding shareholders over time. A payout ratio, the percentage of earnings a company pays out as dividends, below 60% suggests the company has sufficient retained earnings for future growth and reinvestment. Moving along, we approach balancing dividend growth and high-yield stocks. Dividend stocks fall broadly into two categories. High-yield stocks offer significant dividends now, but may lack growth potential. Dividend growth stocks might have a lower yield at present, but they harbor the promise of substantial future growth. Your portfolio should ideally include both types, ensuring a balance of immediate income and future appreciation. Aim for a balance between current income and future dividend growth potential when selecting dividend stocks. The final stop on this journey is periodic reevaluation. Like a garden, your portfolio needs regular care and attention. Re-evaluating it ensures it remains in alignment with your financial goals and can adjust for changes in market conditions or in the companies you've invested in. Review your portfolio at least annually, but also consider monitoring it more frequently if significant changes occur in the market or the companies you've invested in. During the re-evaluation process, analyze the performance of your portfolio, assess any changes in your investment goals, and consider rebalancing if necessary. Rebalancing involves adjusting the allocation of your investments to maintain the desired asset mix and risk profile. For instance, if you at first bought tech stocks like Apple or Nvidia, you may want to buy real estate or healthcare stocks next, or even sell some of your tech stocks. This ensures that your portfolio continues to reflect your evolving financial objectives and market dynamics. Now let's put theory into practice and explore potential picks for a diversified dividend portfolio. Procter & Gamble. This consumer goods leader has a robust history of stable dividends. Their extensive portfolio of products, spanning from toiletries to laundry detergents, ensures a broad consumer base, making it a reliable addition to a dividend portfolio. Johnson & Johnson. A cornerstone of the healthcare sector, Johnson & Johnson has a solid track record of dividend payments. Regardless of economic conditions, healthcare remains a necessity, making Johnson & Johnson a resilient pick for your portfolio. Apple. Known for its innovation and globally loved products, Apple, though offering a lower yield, holds massive potential for dividend growth, making it a consideration worth serious thought for long-term investors. ExxonMobil. With high dividend yields and comprehensive operations, this energy sector veteran can add valuable diversification to your portfolio. Although the energy sector can be volatile, Exxon's broad operational base offers a degree of stability. AT&T. A dominant player in the rapidly evolving telecommunications industry, AT&T offers attractive dividends. With the world becoming increasingly connected, AT&T is well positioned to reap the benefits, making it a solid dividend stock. The journey to a diversified dividend portfolio doesn't happen overnight. It requires patience, thorough research, and the bravery to make informed decisions. Over time, it can evolve into a steady income source, contributing significantly to financial independence. Now that you know how to build a diverse portfolio, how do you start to actually build it with a small investment? Check this video next to find out how with just $5 a day.